Let's talk about $100, not 10,000, not even 1,000, just $100 a month, and what actually happens inside your bank account, your brokerage app, and honestly your own head over the years that follow the decision to start. I'm not going to tell you that $100 a month turns you into the next big tech billionaire, because that's not how this works, and anyone telling you otherwise is selling you something. What I am going to tell you is that the amount you start with matters far less than most people think, and what that first $100 sets in motion matters far more. There's a reason financial advisors and everyday investors who've actually built wealth keep coming back to this same starting point, and it has nothing to do with getting rich quick. It has everything to do with a shift that happens the moment you actually press confirm instead of just thinking about it. Here's what nobody tells you about month one, and it has almost nothing to do with money. Setting up a brokerage account, linking your checking account, and scheduling an automatic transfer of $100 into something simple like a broad, low-cost index fund tracking the S&P 500 takes about 10 minutes from start to finish. The next morning, your life looks completely identical to the day before. Your balance still says $100, nothing about your day feels different, and if you're being honest with yourself, it might even feel a little anticlimactic. But something did actually change, and it's not visible in your account balance. The night before, you were someone who intended to invest eventually, someone who kept meaning to get around to it, who watched other people talk about the market from the sidelines and told yourself you'd start once you had more saved up, or once things felt less complicated. The morning after, you're simply someone who invests. That's the entire shift, and it sounds small when I say it out loud, but it isn't. Research on financial behavior consistently shows that the single strongest predictor of whether someone keeps investing over the long term isn't their income, isn't their starting amount, and isn't even how much they understand about the market. It's simply whether they started. The people who never begin stay stuck in the same holding pattern for years, still telling themselves the same story about waiting for the right moment. The people who start, even with a small, almost forgettable amount, become a different kind of decision maker almost overnight. And that difference compounds every bit as much as the money eventually will. Now let's fast forward to the point where things actually start to feel uncomfortable, because this is where most people who quit. Somewhere around month 6, you'll have contributed roughly $600 total. And at some point, likely without much warning, the market will have what's called a correction, a normal, completely expected dip where stock prices pull back for a stretch of weeks or months. You'll open your app expecting to see something close to $600, and instead you might see something like $560. On paper, you're down $30 or $40, and your gut reaction, the very human, very normal reaction, is going to tell you that something went wrong, that you made a mistake, that maybe investing wasn't for you after all. This is the fork in the road, and it's worth understanding both paths clearly before you're ever standing at it yourself. One path is what most beginners actually do. They panic. They pull their money out. They move it to cash where it feels safe, and then months later, once the market has quietly recovered without them, they watch everyone else's balances climb back up, feel a wave of regret and fear of missing out, and buy back in at a higher price than what they sold at. That cycle, selling low out of fear and buying back high out of FOMO, repeats itself every single time there's a downturn, for the people who never break the pattern. The other path is simpler than it sounds, and it's the one that actually builds wealth. You look at that $560 balance, You remind yourself that you're not investing for this week or this month. You're investing for the next 10, 15, 20 years. And then you close the app and keep contributing exactly the same $100 the following month. That's it. That's the whole move. And the data on why this matters is honestly a little startling. Missing just the 10 best trading days over a 20-year stretch, the handful of days when the market jumps sharply has historically been enough to cut an investor's total returns roughly in half. Nobody can reliably predict which days those will be, which means the only realistic strategy is staying invested through the uncomfortable stretches so you're guaranteed to be there when the good days show up too. Now let's actually look at what the math does over time, because this is where the abstract idea of compounding turns into real numbers you can picture in your own account. Assume you're investing that same $100 a month into something tracking the S&P 500, earning roughly the historical long-term average of around 10% annually. By the end of year one, you'll have contributed about $1,200 of your own money, and your balance will sit around $1,265, meaning the market has added roughly $65 on top of what you put in. It's not a dramatic number, and it's not supposed to be yet. This early stretch is the part that feels the slowest, and it's exactly why so many people quit before the good part even starts. Push forward to year 5, and you'll have contributed $6,000 total, with a balance closer to $7,800, meaning the market has now added around $1,800 on its own, and by this point your investments alone are quietly generating something like $65 a month without you lifting a finger. By year 10, you've put in $12,000 of your own money, and your balance has grown to somewhere around $21,000, meaning the market is now doing more than 40% of the total work. Somewhere around year 12 or 13 comes what's genuinely the most important moment in this entire process, sometimes called the crossover point. By then, you'll have contributed around $15,000 to $16,000, with a balance near $27,000. And this is the moment where your annual investment gains actually start to exceed what you're contributing each year. Your money starts generating more than your paycheck is putting in. Fast forward to year 20, and you've contributed roughly $24,000 total, with a balance near $68,000 or $69,000. By year 30, your own contributions total around $36,000, while your balance sits close to $197,000. Run the full math on that, and for every single dollar you personally put in over those 3 decades, the market added roughly $4.50 on top of it. That's not a rounding error. That's the entire argument for starting now instead of waiting. Naturally, the next question is, what happens if you can eventually contribute more than $100 a month? And this is genuinely where the bigger numbers start showing up. That same 30-year timeline at $200 a month puts you close to $395,000. Push it to $300 monthly, and you're looking at somewhere between $500,000 and $600,000. At $500 a month, you land close to the $1 million mark. And if $300 a month sounds unreachable right now, it breaks down to about $10 a day, which is a genuinely different question than, can I save $300? It's, can I find $10 somewhere in a single day? And for a lot of people, the honest answer is yes. Here's the part that should actually create some urgency, though, and it's the cost of waiting rather than the reward of starting. Someone who begins at 25 and contributes $100 a month for 30 years ends up putting in $36,000 total, landing around $200,000. Someone who waits until 35 to start, just 10 years later, has to contribute $300 a month, triple the amount, over the remaining 20 years just to land in roughly the same place, having put in $72,000 of their own money to get there. Same ending balance, dramatically more money out of your own pocket, simply because of a 10-year delay. That gap is what people mean when they talk about the cost of waiting, and it's a far more expensive mistake than most people realize until they're the one living it. So what actually changes the moment you start, beyond the balance itself? You start noticing where your money goes in a way you probably didn't before. You start seeing every dollar as something that can either grow and work for you over the coming years, or simply disappear into something you won't remember spending it on 6 months from now. That's the real shift behind the advice to pay yourself first, treating your future self as the very first bill you pay each month, ahead of subscriptions and takeout and impulse purchases, not because those things don't matter, but because none of them compound the way consistent investing does. If you're in your 20s or 30s reading this and thinking you'll start once you're earning more or once life feels a little less chaotic, understand that the version of you 10 or 20 years from now is going to wish you'd started exactly where you are right now, with whatever amount you can actually commit to consistently, even if it's $50 instead of $100. The amount was never really the point. What $100 a month actually buys you isn't a stock position, it's a habit, a mindset shift, and a decade-long head start that no amount of money added later can fully replace.